Here's our part 2 video for chapter number 9, dealing with retirement plans. Part 1 was the video for estimated tax payments. Retirement plans was probably covered back in chapter number 5. So here in chapter number 9, we're just continuing to review the different characteristics, different types of retirement plans, especially for small businesses. The word qualified means the retirement plans have to be approved by the government and it has to meet certain characteristics. For example, the plans have to be for the benefit of the employees and not necessarily for the benefit of the owners of the company. The owners could also be employees at the same time. Retirement plans shouldn't discriminate among employees, and discrimination is not race, gender, sex, age, but in this case, it's the amount of income level, high or low paid wage or salaries. Now, of course, you can contribute more into the retirement plan for higher paid employees, but all employees, uh, qualifying employees, should be able to participate in the retirement plan. This word vesting means what is the right for the employee to keep the money at the time they leave the company or they retire. If the employee contributes their own money into the retirement plan, they get to keep all of it. They're 100% vested in that contribution and any earnings on it. If the employer contributes money into the retirement plan for the employee, the employer can possibly withhold the vesting, the right for the employee to keep the money, maybe up to 3 years. Or maybe you can phase in the vesting, possibly up through 5 to 6 years long. But once the employee meets the requirement, any amount in the retirement plan allocated to that employee has the right to take that money, either again when they retire or when they leave the company. The word distribution means taking money out of the retirement plan. Of course, putting money in is called contributions, either made by the employer or the employee. Let's do a review of some basic characteristics and types of retirement plans. Back in chapter 5, one of the main type of retirement plans mentioned there is a so-called employee-sponsored plans. So you don't need to have the employer involved. Just the employee has to set up their own plan. And the most common one, of course, is the individual retirement accounts. And you generally have two types. There's really more than two, but generally the two main types of IRAs is called either traditional, where the employee may be able to claim a deduction when they contribute money into their IRA, or another type is called Roth, where there is no deduction. But the benefit of contributing into a Roth IRA is that the earnings of the Roth gets tax deferred, and possibly when there's a distribution made, qualifying distribution, typically after age 59 and a half, it's all tax free. Whereas distributions from a traditional IRA, to the extent it was deducted and any deferred earnings, is going to be taxable when distributed. Probably the Roth type IRA is becoming more and more popular as compared to the traditional IRA. On the other hand, we have employer sponsored retirement accounts. In other words, the employer has to set up these types of retirement plans, not like the IRAs. And there's generally two main types of employer sponsored IRAs. One is called defined benefit, defined benefit. And maybe another name for this is called pension plans. Pensions or the benefits of a pension plan the employee gets is based upon how many years they work with the employer, based upon how much they earn, maybe an average over the years they earn from the employer. And then some arbitrary amount is set up to be given to them as an annual pension, maybe 50% of this average pay, and it'll increase all the way up to 50 or higher based upon the amount of years. Based upon that expected benefit, based upon the life expectancy of the employee, based upon the estimated date they're going to retire, based upon if there's a joint benefit with a surviving spouse, the employer has to estimate now as the employee works how much to put into the retirement plan. Sometimes we call that funding. And it gets kind of complicated, so you need to have a professional involved if you have a pension plan. But pension plans are expensive for the employer, especially if you have employees that uh, are going to have a long life. So more and more you'll see pension plans being used less. Probably the only place you still see pension plans utilized is state or county or federal government employees are covered with a pension plan. Otherwise, even big companies are probably canceling or stopping their pension plan in favor of another type of plan called a defined contribution plan. Okay, defined benefit still has contributions, but it's based upon the benefit that expected that the employee is going to get when they retire. Whereas defined contribution plans, we just figure out how much we're going to put in each year for the employee, and that's it. Whatever's in the plan the employee has is what they're going to get at the time they retire or leave the company. So there's a few mentioned here in Chapter 9 for defined contribution plans. One type is called a SEP. These are all acronyms that I cannot remember, but I just remember the acronym names. A SEP plan, contributions into the plan are only made by the employer. So sometimes there's a set amount the employer has to put in every year based upon a percentage of the employee's pay, something like 2 to 3%. Be it a good year for the company or bad, the employer has to contribute that amount. The amount can be bigger, but it has to have a certain minimum amount. And again, this is only contributions made by the employer. It's um, it's not uh, anything made by the employee. The other one mentioned, again, another acronym is called SIMPLE. And here, both the employer and employee can contribute into the plan. Sometimes there's a maybe matching amount the employer puts in based upon what the employee puts in, or the employer just puts it in anyway, no matter if the employee puts it in or not. Okay, that's a simple plan. Both employer and employee can put in. And there's dollar limits mentioned that we'll see on the next page that can go into these plans. Another type of maybe defined contribution plan is called and all of these maybe is a name that applies to everything here. Profit sharing plans. Sometimes the old plans are called KEO plans or HR10 plans. These are old-fashioned names, but some of them are still in existence. Of course, the more common ones now are the 401k plans, where again there's dollar limits of what the employee and employer can put in, and maybe if there's just the owners are the workers of this company, maybe you want something called a solo 401k, just to cover the main owner and maybe the spouse that's also working for the company. 401k plans are a little bit more complicated than the SEP and simple, but based upon there's a new law that was passed last year. And again, it's another acronym called SECURE. SECURE. There's a C in there someplace. Anyway, based on the 2019 Secure tax law, makes it easier for companies to set up 401k plans, especially smaller companies. And they give them tax credits to set up the plan. And additional tax credits if they automatically enroll new employees, yeah, to help them get started saving for retirement. And these credits can last up to, I believe, 3 years. Okay, so some other names you may hear not applying to maybe businesses are stuff like 403B or 457B or thrift savings plans or employee stock option plans. There are a lot of different ways companies, organizations can help set up retirement plans for their employees, yes? So we're just kind of briefly going over these types here in our chapter. So in the case of SEP and Simple, there's dollar limits. For example, in the case of SEP, the amount you can put in. Remember, SEP is only employer contributions up to 25% of the employee's pay. Of course, most employers won't do that, yeah, but the dollar limit here is this 55,000. And I think it's adjusted for inflation each year. In the case of the simple plan, sometimes they call it simple IRAs, there's a 12,500 limit. I believe that's for 2018. 2019, I think it's 13,000, 2020, 13,500. There's an extra 3,000 if the employee is 50 or older. And sometimes we call that a catch-up. Give them additional limits to contribute more for the older employees. So we also talked about, again, 401ks, and here's that solo version just covering the sole employee, probably the owner of the company, or maybe the spouse of the company, versus traditional IRAs. And again, you cannot discriminate now between the owner employee and other employees if you have all of those people working for that same company. And we talked about vesting 100% of whatever the employee puts in, and then gradually 100% of what the employer puts in, either after 3 years or gradually over 5 to 6 years. The employee can contribute also into the 401k up to this 18,500, again adjusted for inflation, an additional amount if age 50 or older. And again, the total contributions into all of the retirement plans for just that one employee cannot be bigger than 25% of their pay or this $55,000 annual limit. Let's talk about another related topic called rollovers. A rollover is transferring money from one retirement account into another retirement account. So the typical example is when you retire from a company that has a 401k plan, maybe even a pension plan, instead of taking the money as a distribution all at one time and have a big tax hit, they can transfer the money directly or indirectly to an IRA account. And only now when they take the money out of the IRA will there be a tax to the employee. So here it mentions in the two main bullets, there's two main types of rollovers. One is called a direct transfer. Again, from one, they call it trustee of the old retirement account to a new trustee, the new retirement account. And the money goes straight from one to the other. So the employee taxpayer doesn't see any money at all. And it should be all tax-free. Now, possibly the taxpayer has to report this transaction on their tax return, but it's not going to be taxable. Now, the other type of rollover, again, this one was called a direct transfer. The other type of rollover is called a distribution rollover. Now, remember, we used the word distribution before when money is paid out from the retirement plan to the employee. And of course, typically that's going to be taxable. But if the employee transfers that money within 60 days, okay, 60 days to the new retirement account, then that distribution is gonna be tax free. Okay, and then it's kind of strict about this 60-day period. Once you receive the money, you have 60 days to retransfer it back into another retirement account, and that's going to prevent it from being taxable. Now, if the money is being distributed from an employer sponsored plan, it's a requirement to withhold 20% of that as taxes, just like withholding taxes from your salary or your wage paycheck. You just get a credit on your tax return when you file it. So that means the taxpayer is going to get 80% of that distribution. But if you want to have a tax free distribution rollover, again within that 68-day period, you got to roll over 100% of the money that was distributed, be it withheld or here directly distributed. And if you only get 80% and you have to roll over 100% to prevent it from all being taxable, where is the other 20% going to come from? Well, this can only be used when you file your tax return. And you got to make that 100% rollover within 60 days. So almost most times the best way to get money into a new retirement account is to use this direct transfer. Here it mentions that if you get a distribution before your age 59 and a half, a distribution from a retirement account, in addition to reporting that distribution as taxable income, there's additional 10% penalty tax tacked on. Let's illustrate this rollover situation. So we have one retirement plan, plan number one. It could be an employer plan, it could be an IRA, and then here's another retirement plan. Again, could be an employer plan or an IRA. And if you want to transfer money from one to another, you typically contact this plan number two, the managers or trustees of that plan, to help you transfer the money over from and request it from plan number one. So this is going to be a direct transfer. And again, may be required to be reported on the taxpayer's return, but it's going to show zero taxable. There's going to be a code, maybe letter or number to indicate this is a tax-free transaction. Or you could have a distribution to our so-called taxpayer coming out of that plan number one. And again, if plan number one is an employer-sponsored plan, there's going to be 20% withheld, and that's going to go to the government, just like payroll taxes. And you're only going to get 80%. So our taxpayer, when they prepare their return, is going to report 100% of the distribution if there's no cost basis to offset and this distribution. But they get to claim that 20% as a withholding when they file their tax return. Now, if our taxpayer wants this distribution to be tax-free, we're going to have a rollover within 60 days to the plan number two, the new plan. And what you got to do is contribute 100% if you don't want any of that initial distribution to be taxable. And again, you only got 80 here. So you got to make it up with the rest. So that's why this direct distribution is the best way to go. Now, sometimes you request a direct distribution, but what you get is some kind of check mailed to the taxpayer, but not in the taxpayer's name, but in the name of the plan number two. And the taxpayer only shows up for the benefit of FBO, and you just redeposit that check, be it within 60 days or longer. But again, if you get the cash, then you have 60 days to transfer the whole thing 100%. Again, 100% into plan number 2 to roll over. Let's talk about tax credits related to savings. Tax credits was the main topic back in chapter number 7, but they save this credit because it's related to retirement savings. So if the taxpayer has relatively low income and they get motivated to save, the government is going to award them with a credit. Here it mentions the credit is non-refundable. In other words, if the tax is already zero or reduced by previously used or calculated credits for the year, this credit will be wasted. The form we use to calculate the credit is this 8880 form. And if it's a joint return, you have a column for the taxpayer and spouse. And in line number 1, you put in IRA contributions, be it traditional, where we maybe get a deduction, or Roth, where there's no deduction. Also, if the taxpayer has money withheld from their pay to go into the employer retirement plans. Okay, but now what you got to do is reduce all of these contributions by any distributions that the taxpayer is taking out. Yeah, it wouldn't make sense that you take out money from a retirement plan, you put it back right in to get a credit. Yeah, so here you got to reduce the contributions for the year by any distributions for the year. And the maximum net amount you can put down here for each taxpayer is $2,000. Yeah, 2,000. So if you're filing a joint return, the maximum you can put down here for contributions is 4,000. And the credit is going to be based upon a certain percentage, and the percentage is based upon one of these tax filing statuses. And you go down and find the adjusted gross income down this columns, and then go across to find the percentage of that $2,000 or $4,000 amount. Like here is 50%, and here you can see it gets phased out to 0. Here's 10%. Again, if your AGI falls within this. And now eventually you'll get the credit down here. Again, the credit is used after other credits like the dependent care credit, yeah, or other dependent credit. Yeah, so this is used after other credits are utilized. And again, this is non-refundable credit. Okay, let's stop here. Again, you got to make sure you read our chapter 9, yeah, at least for those 2 sections, estimated tax payments and retirement plans. If you have any questions, you can email me or set up a Zoom meeting.